Hello and welcome. So this is the third part in the estate and gift tax series videos. So first video I discussed the estate tax provisions. The second video I discussed the gift tax provisions, and now this is the video where we discuss strategies where how we can legally avoid or reduce the estate and gift tax impact, especially for NRIs who are returning back to India. Right. So let us start. Again, also disclaimer that it's a very complex topic, one of the most kind of complex topic that even for whatever videos that I've made on this channel, this is, I think, one of the most kind of complex and required a lot of time for me to do the research and everything. But I'm not an estate attorney, so please consult a proper estate attorney for your situation. And my request is that first you watch the videos on estate and gift tax provisions, because unless and until you have a hold on the provisions, this video will not, you'll it will go as a bouncer. You will not be able to uh, get it certain points that I'm making here. So first watch the video on estate tax, second watch the video on gift tax, then come to this video, right? And when you are watching the video, this requires some careful attention. So maybe you can watch it where you are not kind of distracted, or and you can just devote your full attention, because this is a very very complex topic. Okay. uh, Now this video, basically I will be covering strategy pointers, right? Pointers on the individual strategies. Discussion, I will not be able to go deep into any one particular strategy, right, because of the time constraints that we have for an individual video. What I will do is that after this video, depending upon the important the strategies, I will try to cover it in detail on a standalone level, right? Okay. Now the strategies differ, right? Because the provisions are different, right? Provisions are different for US citizen resident and non-citizen non-resident. So the strategies are also different. My focus in this video is the uh, non-citizen non-resident cases, because this is where there is a very lower threshold of 60,000. For a US citizen resident, the threshold is 13.61 million, right? That's a really big amount, and less cause for a worry. But this is where the 60,000 thing, people are not even aware that this is the estate tax liability that they can incur, right? So this is where I'll be focusing the most part of the video. Now, important thing, regardless of whatever you do, see, friends, we don't think about our death. This is a topic, why, it's a topic where I don't want to think about my death, something happening to me. But when that happens, right, the mental load that comes on the spouse, the wife especially, right, on handling the entire thing, the paperwork and everything, and it's really really difficult, because I've seen that very closely, right? So my point is that please also focus. So we think a lot about investment planning, where to invest, what are the returns. Please 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 have a estate plan for both your US and the India investments, right? Now because of the different succession laws, US, you need kind of different plan for a US investment and different plan for an India investment. Please contact the respective professionals who are experts in the field, get your estate plan in place, and please pay attention to this, right? It's just not that we only focus on the investment. Don't think about what can happen if I'm not alive, right? How will my wife be able to process everything, right? Do all the paperwork and everything, right? Now share your investment details with spouse on her email. Maybe have a record somewhere that she can access after your death, and also include her in discussion. I have a lot of discussions with especially returning NRIs who coming back to India. There are few people, like maybe I will say 1 or 2 out of 10 people, who get their spouse also in the discussion. This is so important. At least have her in the discussion, so that she also knows what's the plan, where are we going, where are the investments. At least she knows for a fact that okay, these are the investments we have, right? Also have an updated contact list of professionals like a CA in India, or a CPA in US, or estate attorney in US. Those, should have a handy list, maybe an Excel sheet where you build all these names, their addresses, their numbers, so that she can contact them, right? So this is just apart from whatever we are going to discuss, but this is like the base. Okay, now please understand, because this is a muddy, the definition of resident is muddy for estate and gift tax purposes. It's not the definition as per the income US income tax law. Therefore, especially for cases where like an Indian goes to the US and then stays some time, maybe in whichever visa, and then comes back, right? Even a green card holder is not relevant. You may have a green card. Now, green card has a strong presumption of being a resident, but it's all facts and circumstances dependent. So wherever you feel that there is somewhere that you may be on the wrong side of the law, better to take professional advice, because here in this field, for income tax purposes, it's very clear. GC, citizen GC or substantial presence test, which is based on the number of days stay, very clear. Here it is not that clear, so it's based facts and circumstances. So please take proper professional advice. You don't want to be in the wrong on the wrong side of the law, right? Okay. Now let's come to the strategies for US citizens and residents. I will not spend much time here, right, because they have a very big amount threshold. So if both spouses are US citizen and or resident, there is a very high threshold of 13.61, like we discussed in the estate tax video, and also there is an unlimited marital deduction for surviving spouse, right? So I'll not go deep into the provisions now for this video. Because of both these things, very high threshold, unlimited marital deduction, so almost no cause for worry unless you are like a super rich, because then you'll have lot of high profile advisors also, attorneys also advising you. But so this is out of the question because of the limit. However, please understand that under the Tax Cuts and Jobs Act, this limit, actually this act had come in 2017 when Trump was there as the president. Now this has a sunset clause of 2025, where December 31st 2025 this limit will become again half, which reverts back to the 5 million, right? So please pay attention to that, maybe if it is relevant to you. It may revert, so it is depending upon the elections and everything. Okay. Now, in case of death of spouse, it is always advisable, even if your estate is uh, below the threshold of 13.61, to file a 706, make a DSUE election, even if the assets are below, so that the unused portion of the whatever exclusion, that can get automatically transferred in a tax free way to the surviving spouse, right? Now, issue comes if you are a USC, spouse is a non USC. Now, in that case, lifetime gift, if you do that, that's not a problem, right, within the lifetime. But in case of death, there is no marital deduction, because please understand here the psyche of the US government. They don't want on your death assets to go to a non-citizen spouse, right? So anyone who is non-citizen. So this may be considered as a kind of a discrimination also. This is how the provision is. Spouse is a non-citizen, no marital deduction on death. That means any transfer to the spouse in case of death will be a problem. You cannot claim the unlimited marital exclusion. In that case, you should take help of QDOT, qualified domestic trust, where decedent, that means you, transfer your assets even within your lifetime to a QDT, right? And surviving spouse is the beneficiary. Spouse is the beneficiary, and she can get the income from the trust. There are certain limitations under the trust. It's like a whole topic to be discussed in detail. Please check with your attorney, and if you feel that this is one way you can, I mean, for a non, if the spouse is non-citizen, you can escape the estate tax provisions legally. Please do it. It's a very recognized way of doing it. Right now, even if you die and the surviving spouse is there, she can also do this election before filing the return. She can make that kind of election. There is a provision in the estate tax law where she can make that election, and then in the form 706 she can make that, she can create that trust, and then she can make that election in 706. Even that is allowed. So even After your death, this kind of a strategy can be done to escape the tax implications. Okay, now combination of US insurance. Now, again, one strategy that attorneys use, and what I had came across in my research, is that a mix of US life insurance and Q dot, right? And when you take US life insurance, the how you structure it is that uh, I take the insurance. If something happens to me, the payout is, if something happens, I take it on the name of me and my wife. So payment payout happens if something happens to my me, and after that even my wife, and then the beneficiaries get. And then there is a Q dot. So there is a kind of a, it's like a combo of US life insurance and Q dot, right? So please explore it in detail, because this is one of the ways attorneys use to kind of plan around estate tax. Okay, purchase of insurance in US for estate and administrative costs impact. And now, or what you can do is that have a kind of a insurance that you purchase in US for the estate tax aspect. If you are very rich, and so if the assets are going beyond, so you purchase kind of an insurance to take care of the estate tax impact. And because the estate tax, because the insurance for a US citizen, the insurance policy proceeds form part of the estate. So to avoid that, you generally put it in an irrevocable life insurance trust, ILIT, so that it doesn't form part of your estate. The insurance itself doesn't form part of the estate at the time of the death. So this is again a pointer, right? So I'm just giving you pointers. You can do further research on this. Speak to your estate attorney. They will have more insights in these matters. So this is on US citizens and residents. Now let us come to the main thing about strategies for non-citizen, non-resident. Now, please understand, the limit is very low. No matter how much money that you have accumulated in US, anything above $60,000 will have a straight 18 to 40% tax on the value of the asset. Understand this. It's not the profit or the income as a component. It's the value. So a good chunk of your hard earned wealth in US over like 10, 15, 20 years that you worked in US and you're coming back to India, that can wipe out in a second if you come to India and die after that without having planned your estate in US, right? So it requires a very thoughtful consideration by both spouses, because it requires decisions with respect to your investments, selling certain. See what our mindset is when we want to invest. We have money and we want to invest. We don't think about tomorrow as to the estate tax and all these things. We just go ahead and buy a house and all these things. But when it's time to return back to India and we have not got a US citizenship or a green card, or then it becomes all these issues then start uh, you know cropping. So it requires a very careful decision by both spouses. And please get professional advice wherever necessary. Pay some amount, get proper advice rather than just learning from here and there on the internet and all. No, it's a very very complex decision to take, right? So better have a professional by your side, a proper estate attorney who guides you. Now, plan to plannings to start, right? Planning to what to do with the investments should start before you move out from the US, right? It's not that you move out from the US and then you think that, oh, I should have set up a Q dot, or I should have done this and that. No, no, no. It should start well before. In fact, what I will say, it should even, for every decision to invest, you should think before investing. So I always see, definitely one thing is very clear. Given the IRS, it's so, the US regulations are so complex that one is that IRS penalizes you for having non-US investments by so many reporting obligations, by the FTC issues and everything. So my view is very clear that till you are a US resident, always 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 invest in US, right? However, they also have this thing called estate tax. That means when you are moving out of US, and if you forget, they will take a big piece of the cake. The IRS will take a big piece of the cake. So very important to decide while investing it may be a conscious decision that okay, I'll invest in US only till my stay in US to avoid the p fake and all these problems. But at the time of moving, you should be careful that to take the necessary steps to reduce your estate tax exposure. Strong reason has to be there for you to hold US citus property. US basically citus is located property, US property, US assets, not only real estate but any assets above the estate tax threshold of 60,000 in US. So when you are returning to India and you have assets in US above $60,000, every asset, every dollar, you should have a very strong reason why you are keeping in the US. So for some people it is they want to move back to US at a later date. Second, they have USD denominated goals for which they need. Some people have this presumption that USD will always remain stronger, so I want to keep the money to in USD, which I don't agree. It can go either way. No one can predict the India US currency movement 10, 15, 20 years down the line, right? So whatever you have to have a strong reason, right? Okay, now let's come to the easiest and the kind of a no-brainer strategy. Liquidate US citus assets above 60,000 towards the end of the US residency or as early as possible after coming to India, preferably within R0 period in India, right? So when you come back after a long like 10 to 15 years stay in US, you generally get 2 years kind of R0s where India will not ask you about your foreign income. India will not ask for any reporting, any tax, will not apply any tax. This is your golden 2 year window where you can decide. But I will suggest take a decision before the end of the us before leaving US itself, because even after you move within R0 period, if something happens to you, there will be a estate tax risk that will be there, right, for every day that you are there in India. So ideally have it before leaving US only, plan and do certain actions to liquidate those assets. Of course, you'll need to think about the US tax implications on assets if they are standing at a gain. So what will be the capital gain and other things that you have to take into account. When you talk about 60,000, so some people they keep till 60,000 and then they kind of above that they liquidate. But please understand, anything above 60,000 can trigger the tax, right? So if your portfolio is 60,000 and then it will appreciate, it becomes 65,000, so the tax liability will get triggered. So you may want to keep it like 50,000 or something like that, that even if it appreciates, it doesn't cross the 60,000 threshold. Okay, moving money back to India, I will make you a separate video on this. That a lot of questions are there on the tax implications of moving money between countries. See, if you just move the money to India, there is the remittance is not taxable in India, right? There's the remittance per se is not taxable, right? If you take a credit of the income directly in an Indian bank account, India will tax it irrespective of your residential status. But if you just move money from a US bank account to an Indian bank account, remittance is not taxable. However, please maintain source of funds documentation, because you take the money into any Indian bank account, even in an RFC, India can question the source of funds for the money. So you have to have the documentation that this money was earned there, this and this are genuine money. So you should have your tax returns, your W-2, your employment contracts. Sorry, everything you need to keep, right? Okay. So now when you move money to India, there are two choices. One is that if you have a NRO account, you can move to an NRO account. And if you don't have a NRO account, once you come back to India, become a resident, you can open a resident account and transfer. But that money will be then Indian money. It will have restrictions on repatriation. Or a better option is to park it in an RFC account, which is a kind of a USD account. And the beauty of RFC is that the money is freely repatriable anywhere outside India, and it is free from the FEMA restrictions. Under the FEMA law, the law says that any money that you park in RFC, which is based out from your earnings abroad, can be repatriated outside India, and India will not question it. Right. So later on, you may want to do a startup in US or something, and you want to repatriate. If you repatriate the RFC money, there is no compliance required under the FEMA overseas investment regulations. It's a very complex law, so there is no compliance. So your money is practically free. Whatever you want to do, you want to buy a property in Dubai, whatever you can do without the restrictions of FEMA. Because understand this, once you come back to India, you become a you come under the FEMA net. Then you like, I'm an Indian resident as per FEMA. So whatever I do a cross border transaction will have its limits. What I can do, Indian government tells me that you can do this, you cannot do this. But as regards money that is there in the RSC account, there is no such problem. And also, since the money has escaped the US, it's not the US IT's property, there is no estate tax. And the money is also in the USD, right? So that is one more benefit. Okay. Other option. So one is that you move to a jurisdiction like India. Another is that you move to a jurisdiction like Ireland, right? And that is allowed under FEMA. FEMA Section 6(4) allows that if you have any genuine earnings when you were a non-resident, you can send it anywhere, reinvest it anywhere. We will not question. India will not question, right? So you can liquidate your US assets. For example, Vanguard, if you have funds, ETFs in Vanguard, Vanguard has similar ETFs in Ireland, absolutely similar in ETFs holding the US stocks, but the investment is there in Ireland, right? So again, now this is a strategy that is used by a lot of people. Please check with your attorney. This is a strategy that is used for escaping the US estate tax, that moving the investments from, so liquidating them and then moving them and buying them in the Ireland domiciled funds. So Vanguard is there and others may be also there. Or you can move your money to a low tax jurisdiction like UAE. Now UAE also has very very friendly laws. There is a full Dubai International the Family Wealth Center is there, and they have specific regulations on family foundations. And also, if you're a high net worth kind of an individual, you can also explore UAE as a jurisdiction. And they are also regulated under the I think the common law, not the Sharia law. So those friendly regulations are also there. But please check the host country's requirements and the India taxation reporting everything. Pay attention to currency aspects. Now, why currency aspect? Because if you want to keep the money in US for whatever reason, and the expense you are going to incur will be in INR, maybe for your retirement, there will be a currency risk. Or it's the reverse, that just because you want to escape the estate tax, you move the money into INR or maybe in any other currency, and the that the expense will have to be incurred in USD. To that extent, there will be currency risk. So you'll have to be okay with that. It's a conscious decision you will have to take. Okay, don't liquidate anything, everything. Now, when I talk about liquidating, uh, uh, I'm I'm not saying that make it zero. Keep some amount in US bank account, or move when you're moving to India. Keep some amount parked in the RSC account. As I told you, it is excluded from FEMA purview, FEMA regulations under Section 6(4), because that amount you can use free from FEMA restrictions anywhere later outside India. Now, before moving from the US, and this is what I see in portfolios of a lot of people, they have a lot of 401ks spread with various employers. So they have not yet consolidated. So always first consolidate your investments into a traditional IRA, right? Consult, because that will help you, because anyways this is a very complex topic. So first you consult. So if you have like your kind of investments with different brokerages, at least before, prior to moving, have it in one brokerage or one bank, or so that it's easier to transact. Now, when you talk about uh, liquidating, there are restrictions. Like for example, 401k, there are in certain cases restrictions. For example, you are moving to the Indian arm of the US employer, where there is a restriction that you cannot withdraw, right? So that you'll have to live with. You cannot do anything, right? Then there are penalties like 401k or traditional IRA. If you withdraw, then there is a 10% additional tax that you'll have to pay, right? Then if you withdraw within RNOR in India, no problem. But after RNOR, India will also have, there will be tax implications. So all that you need to kind of study for each of the investments, and then take a decision. Maybe an Excel sheet you can list down the investments and what are the tax applicable tax. You sit with a professional, discuss, and then make a plan of action. Okay, this I will do for this I will do for this. The best course of action, considering US income tax, India income tax, US estate tax, Indian FEMA regulations. So it's a complex cocktail of all these regulations which come in play. Okay, now another one option is that you move your existing US investments to securities that don't fall in the definition of US cities assets for estate or gift tax. So please refer to my video on estate tax, right? Where certain, like there are certain portfolio bonds, there are certain deposits by the US bank, right? Bank deposits, they don't fall, right? So you may want to kind of keep your money in that, right? um, or maybe life insurance in US, because for a non-citizen, non-resident, life insurance policies in US is not. But again, check the charges and everything, check the investment returns that you will get, right? That is again one strategy you can do. Okay, sorry. Then, okay, one thing, if this is a topic that bothers you and you have significant US investments, please try to obtain a US citizenship for self and spouse ASAP, because if you and your spouse become US citizens, then the matter ends there, right? Then you don't have to take care of all these aspects, because the threshold for a US citizen is 13.61 million, so it's very high. However, if become after becoming US, so once you become a US citizen, then you are basically wed yourself to the US tax system, and for life, till you renounce the citizenship. And then matters become complex when you return back to India, right? Because then there will be certain foreign reporting requirements and all those things. I made a separate video on US citizen returning back to India, US citizen or green card holder. You can check that. So just take a conscious decision. If you want to keep most of the assets in US, best if you can get a US citizenship. If maybe you can get, then that's the best thing. It can kind of escape you from these problems. If your spouse is US citizen, you are in luck, because then you can claim unlimited marital deduction for transfer within life or at death. So no worry on that count. If your spouse is a non-US citizen, very good option to create a Q dot, qualified domestic trust, put the assets in the Q dot, and get the tax deferral of the estate tax liability. In case of your death, that election can be made in Form 706. Your wife can get the assets without any estate tax liability. So that is a very good option and highly recommended option if you want to keep assets back in US, like a property house, and you don't want to sell it. So that's an option. Okay, now another strategy is gifting. Now, gifting of US property. When I say property, it is anything, money, shares, house, whatever. US assets to non citizen, non resident spouse up to 1.8 lakh, 85 lakhs per year you can gift without even reporting it under Form 709. And that spouse can then invest the funds in India or keep in an RSC account in India. So what is happening here? And you can give to an Indian resident close relative up to $18,000 per year. Now, what here it happens is there is no reporting requirement under Form 709, right? The money doesn't go towards reducing your 60,000 exemption, right? The spouse can then invest, or you give to an Indian resident close relative, right? Now, issue here is that one is that you need to keep in mind the Indian clubbing provisions, because you are gifting without adequate consideration to your spouse who is investing the funds in India. So if she invests, then the income from those investments may still be clubbed in your Indian tax return. So just check on that, right? Second is giving gifts to Indian resident close relatives. It may have succession planning kind of issues, succession issues, because you lose the ownership of that money. Tomorrow, if there is a dispute or something, right? So don't blindly use this kind of strategy. You lose your right of this kind of these funds just to save on the estate tax. Please think on that. So keep in mind the Indian tax, FEMA, succession related considerations while gifting. When you give, there has to be a proper documentation. The receiver has to have the proper documentation, especially if the funds are invested in India, because in that person's return, right, that person, the bank, Indian in the financial institution will report it to the bank. They will see a lot of money coming into the invested by that person, whereas there is no that much income. So you have to have enough documentation to prove that it's a genuine money. And the Indian resident, whoever you gift to, the donee, should file a tax return in India and declare that gift in Schedule EI in the tax return, so as to say that, okay, I declared it as an exempt income in my tax return, right? And when you are gifting to Indian resident, it has to be close relative only. Otherwise, it will be taxable. If it's not a close relative under sections 56 of the Income Tax Act, it may then be taxable to the relative. Please check state laws. So whichever state that you are living in, right, that state may also tax you even after you move back to India, especially if you qualify as a resident of that state. And that generally happens if you hold a property in that state. So that state can continue to deem yourself, or if you have any income sources from that state, so state may have its rules to deem you as a resident for estate tax purposes. And the state has its own estate tax, right? So that also, the state law you need to check, especially if you have a real estate ownership. Now, a very good way you can plan estate tax is investment in 5 to 9 plans. So 5 to 9 plans are specified. It's called qualified tuition plans. For it's a tax advantaged plan. Some states give the corresponding tax benefit. Some states don't give. Basically, states have these plans, right? It's for the college education of the kids. So when you invest in 5 to 9 plans, what happens is that generally you have a kind of a gift limit of 18,000 USD per year per donee. Here you can, like, in one shot you can do like 90,000, and that will be ratably apportioned to 5 years. So in one shot 90,000 goes out from your gross estate. And if you have two kids, you can, like, 90,000, 90,000, 1,80,000 goes. So that's a very good investment that you can do. Similarly, gifting, if you do, it takes a lot of money away from your estate, right? So you can evaluate this. Then taking out US property on loan or getting a loan against the property, right? So either you take the property on loan, because the debt is then, it gets reduced from the asset value. Donating assets to a qualified charity, you can make a will where you donate certain assets to a qualified charity. So that will, you can get a credit of that in your form 706 NA, right? Okay. Then foreign non-grantor trust, now foreign blocker corporations. Now these are advanced strategies, and this has to be done only with the help of a professional estate attorney. Please understand, there are a lot of these consultants who sell you these kind of schemes. However, they can run foul of the IRS regulations and can be treated as abusive kind of instruments to escape tax, and then there will be penalties associated with it. So, what basically is that you can put the asset into a foreign non-grantor trust, or you can, like, what you can do is that you can put your assets in a US corporation. That US corporation can in turn be held by a foreign corporation, say in UAE, and you hold ownership of the that Dubai company, that UAE company, right? So effectively, you are not holding the US assets. The shares in the Dubai company or the UAE company are not US ITUS assets. So that way you can try to kind of plan it around, but these are very complex strategies to be done only under advice of an independent attorney, right? Not the consultants who sell you anything and later then you are at the mercy of IRS for any problems. Okay, if you are purchasing a property in US knowing that you will not get a citizenship or a US green card and you will be returning back to India, then please explore structure like purchasing through LLC or blocker corporations or trust, irrevocable trust, to reduce your estate gift tax liability, and also FOPTA. So if you FOPTA is Foreign Investment in Real Property Act. So if you come back to India, have a property in US and sell it, there is a 15% withholding by the done to be done by the buyer. To manage all that, these complex some structures are there which you can sit with your attorney and kind of explore. Then other option is paying the education and medical expenses directly to the concerned institution. That reduces your exposure for the threshold purpose. And this is the final thing, and this is a bonus for all those who have waited till now, right? you do everything, you liquidate. So first strategy is liquidate whatever you can liquidate without any serious implications. You can explore q dot, you can do all these things. But if there is a still a estate tax kind of a implication that remains, for example there is an IRA or there is a 401k which you cannot, the terms of the 401k don't allow you to sell, so and it is above 60k, it is like 1 lakh. There is a 40 till 40,000, 1 lakh minus 60,000, 40,000 is subject to 18 to 40% tax. Plus, then there will be administrative costs, attorney fees, all these things are there. So, to cover that estate tax impact, you can buy a pure term life insurance in India to cover that, right? So, see, understand, estate tax arises when you die. So when you die, the these implications arise and this outgo in terms of estate tax will arise. But at the same time, you get the proceeds from your Indian life insurance company, and life insurance in India is not a US site use property, so that can kind of a compensate. But it will not compensate for the time that it takes, the 2 year period that it takes for the entire estate to get settled. Till then, your family will not get the money, right? So this is a strategy to cover the residual risk after you do all the above things. Okay, so this was a long video. I've tried to explain it from my end. I know it's very complex thing, but I've just tried my bit. Please do share your thoughts, feedback on this video, and thank you so much for watching this video. Thank you so much.